A very good morning to all the participants of this webinar. We are doing DTRTI Lucknow webinars 2021, and within that, today we are going to discuss the final accounts of non-manufacturing entities under the proprietors under the series of bookkeeping and accounts that we are doing nowadays. Today is 23rd November 2020, and we are doing adjustments in the accounts at the end of the year. So at the end of the year, for a number of reasons, certain adjustments need to be made in order to prepare the final accounts. We are at adjustment number 9, other provisions. So whenever we expect that a loss will occur, but we are not sure, we are not certain how much loss will occur, then what we do is that we create a provision for meeting that loss whenever it will. So for example, if we have delivered goods late, then we know that we may have to pay a compensation for the late delivery of the goods. So what we will do is that we will debit the profit and loss account and credit a suitably named provision account by the expected amount of the loss that is going to occur according to our estimate. So all the accounts which are showing these provisions will appear in the balance sheet on the liability side. However, there are some accounts which are not normally shown on the liability side, like the provision for bad and doubtful debt account and the provision for discount on trade receivable account. Because these two provision accounts are deducted from the total debtors on the asset side. Similarly, the provision for depreciation is deducted from the cost of the asset or the cost of the fixed asset on which the depreciation has been allowed, or on which the depreciation has been included in the accounts. Now let us go to the next adjustment, which is called transverse, involving correction of errors. This adjustment is made by debit or credit of the accounts affected, because we may be doing some error correction. So whatever accounts are affected by those errors, will debit or credit them, and the corresponding effect we will record either in suspense account or some other account. If we know that in which account the effect is going to be there, the corresponding credit or the corresponding debit. For example, if we are debiting an account to make a correction, then either we know which account to credit or we don't know which account to credit. If we don't know which account to credit, then we put that credit in the suspense account, but otherwise we put it in the account in which we are supposed to put it. Because if we have found the reason for the error, then we will appropriately put the corresponding credit into that account. Now, there are some transfers which are also supposed to be made in respect of special charges, like if you have to give salaries to the partner, interest to partner, and wherever some profits appropriation has to be made. So to that respect, in that respect, will debit the credit the concerned parties. Like if you are giving a partner's salary, then we'll debit the partner's salary account and credit the parties concerned, credit the partner. If you are transferring the amount by book entry. And if we are doing it by cash, then we credit the cash account or the bank account. Now we have to remember while making adjustment that every entry will have a double effect, double aspect. One is the debit and one is the credit. For example, if we are making adjustment due to the prepaid insurance charges, then the insurance charges account would be credited and we'll have to make the second entry also. So to complete the double entry, we will debit the prepaid expenses account with the same amount. So, make the adjustment journal entry to debit the prepaid expenses account and credit the insurance charges account. And this prepaid expenses debit balance would be included on the trial balance also on the debit side. Ultimately, it will find a mention in the balance sheet on the debit side or on the right side. Now, students should, as a matter of course, record these adjustments on the rough sheet in respect of various items if a question is asked, and then give their effect in the trial balance before proceeding to draw up the final accounts. So before making the final accounts, these adjustments are to be made whenever a question is being asked in the exam also. Now let us see certain particular adjustments and how they are treated in the accounts. Number one is the abnormal loss that happens of the inventory by way of accident or by way of fire. Sometimes loss may occur due to fire or by theft also. So if the loss is due to the accident or fire, we know that a portion of our inventory gets damaged. First thing that we have to do is that we have to ascertain the value, we have to find out the value of the loss that has been incurred. And once we have found out the loss value, we debit the abnormal loss account and we credit the purchase account. Because so far, when we had purchased the inventory, we had debited the purchase account and credited the party from whom we have purchased. Now this purchase of good that we have got, it has got damaged. So we need to reduce it from the purchase itself. Therefore, we credit the purchase and debit the abnormal loss account with the value of the loss that we have estimated or ascertained. Now this abnormal loss account debit has to be transferred to the profit and loss account to account for this loss. However, if the amount of loss is can be recovered from the insurance company, then we will debit the insurance company instead of the profit and loss account. Because we are not going to incur a loss here to the extent of amount which is recoverable from the insurance company. That is why, of course, we have been paying insurance premium to the insurance company, because so that whenever such abnormal loss happens, they will recompensate us. But once we have debited the insurance company, so we are showing that we are going to get this money back from the insurance company. So the entry that we have made here is that the entry that we have made so far is that we will credit the abnormal loss account and we are debiting the insurance company. So debit insurance company, credit abnormal loss. The first entry, of course, was abnormal loss debit and credit purchase account, credit purchase. Second entry is abnormal loss credit and debit insurance. We get the money back from the insurance company. Insurance company's account will be shown on the asset side because this is a receivable. Now, when we recover this amount, if any part of the loss is recoverable from the insurance company, then that portion which company will not pay us or not recompensate us for would be debited in the profit and loss account. So let us take an example. For example, if goods worth 6,000 rupees are destroyed by fire and the insurance company admits the claim for 4,500 rupees only, they are ready to pay us 4,500 rupees, but they are not ready to pay us the 1,500 rupees. So in that situation, we'll make the journal entries like this, that first we'll debit the loss by normal loss account by 6,000 by the total estimated loss value and credit the purchase. So thereby taking it out from the purchase and putting it into the loss account. Thereafter, we will debit the insurance company for 4,500 because they are going to pay us 4,500 rupees, and we'll debit profit and loss account for the remaining 1,500 rupees, and we'll credit the loss by fire account or abnormal loss account. Thereby, the loss by fire account will not have any balance left. So it will get squared off. The debit that we had put here in 6,000, now that due to this credit, the loss by fire account is now squared off. And these journal entries are shown here in the profit and loss account in the balance sheet. The insurance claim is shown on the asset side of the balance sheet. And of course, in the trading account, the purchases would have been reduced by 6,000 rupees. So that is how the accounting entry has to be made for abnormal loss by fire. Now, secondly, sometimes we are sending goods on approval basis. So how do we account that for in the accounts? Sometimes we sell the goods to customers on either sale or return basis, that if they want, they can treat it as a sale, or if they want to return them back to us, they can treat them, they can return it back to us also. And sometimes we give them a certain time, that within that time you can always return the goods back to us. So sometimes we send them on the sale or return basis, or sometimes we send the goods on approval basis. Approval basis is not a sale. The goods have been sent, but sale has not materialized. And the sale will materialize only when approval is made by the customer. So when we send goods on approval basis, it should not be treated as actual sale till the time it is not approved by the customer. Now, when the goods were sold, whenever we sell the goods, we pass the entry for actual sales. So at the year end, when some goods are still lying with the customers for approval, we have to pass certain entries. For example, if goods costing 10,000 rupees were sent to a customer on sale or return basis, for 12,000 rupees, the entry of the unapproved sale will be made like this, that we will debit the sales by 12,000 because earlier we have already credited sale by 12,000 rupees. So we are reversing the sale entry that we have made. Sale is as yet unapproved. So therefore we need to reverse the sale entry, because when we had sold that amount, we had credited sales and debited the trade receivable account, but now we are reversing that entry by debiting the sale and crediting trade receivable account. Having cancelled the sale by making this entry, we will write the entry for approval. So we will debit the stock on approval account and credit trading account. Thereby, we are moving this amount into our stock, which is just lying at some other place. It is not yet sold. So thereby, this stock on approval account has this debit of 10,000 rupees that will be added to the closing stock in the balance sheet at their cost. Now, goods used. Now let's go to the third adjustment. If some goods have been used not for sale but for some other purpose, just such as we are using some goods for distributing free samples, or sometimes some goods may be used in construction of any assets, or they may be used by proprietor for personal use. In such cases, the amount which is used for other purposes is subtracted from the purchases account, because it was earlier taken as a purchase to be sold. We reverse the purchase entry and a suitable account is debited instead of the purchase account. Now let us say, for example, when goods are given away as donation, in that case, we will credit the purchase and debit donation. Thereby, we are cancelling the purchase and creating a debit of donation. Sometimes it may happen that a proprietor may take away some goods for his personal use. So in that case, we will credit the purchase and debit the drawings account. On the other hand, sometimes the goods are distributed as free sample. In that case, we will credit the purchase and debit the sample account or the advertisement account, thereby treating this amount as an expenditure of the business. Sometimes it may happen that some goods are used in the business for construction of building or the machinery. So if their goods are used for construction of the building, then we will have to transfer this expenditure to building account or to the plant and machinery account, wherever these goods have been used, and credit the purchase. Some goods may be used for maintenance of the business premises or the maintenance of the machinery. In that case, we credit the purchase and debit the repair and maintenance account, thereby treating it as a repair and maintenance expenditure. Now, sometimes what happens is the commission is payable to manager based on some calculation of the net profit that he has got for the company. So, in that case, we have to apply the rate of the commission. Like if it is 10%, then we say 10 upon 100 into the profits which have been made before the commission is being charged. So sometimes commission is paid on net profit before charging such commission, and sometimes commission will be paid on net profit after charging such commission. So in the case of commission on net profit before charging commission, that is very easy. Just apply the rate to the profit before the commission. And in case the commission has to be calculated on the basis of net profit arrived at after charging commission basis, then we have to apply this formula. We apply the rate, that is, let's say 10 upon 100 plus 10, so 110, like 10 upon 110 of the profit. This is in that situation where we are calculating commission on the net profit arrived at after the commission is being charged basis. And once we calculate the commission, then we make the entry commission account debit and commission payable account credit. So by debiting the commission account, we are including it in the profit among the expenditures of the business. And since it is not being paid, it is a payable account, so it's put in the payable account. Later on, when it is paid, it is removed from the payable account and introduced into the party's account, whichever has been paid. So this commission which has been debited here, this will be debited in the profit and loss account ultimately. And to do that, we will credit this commission account and debit the profit and loss account, thereby transferring this commission account balance to the profit and loss account. Now let's take an example of this. If net profit before commission is 1 lakh rupees and the manager gets a commission of 10%, the amount of the commission will be 10% of 1 lakh, which is 10,000 rupees. So it will be shown like this, that 10,000 rupees will be the commission paid and debited to the profit and loss account. And the net profit after reducing from 1 lakh, because 1 lakh was the profit before commission, after reducing 10,000, the net profit which is remaining is 90,000, that amount would be transferred to the capital account. And since this commission is not yet paid, we have already debited the profit and loss account, but not yet paid, so it is credited to the commission payable account, and that commission payable account credit balance is shown in the balance sheet on the liability side. On the other hand, if the commission has to be paid on the net profit after charging commission basis, then the commission will be calculated by doing a 10 upon 110 or 10 upon 100 plus 10 of 1 lakh, which comes to about 9,091. So as you can see here, the commission is lesser by a small amount. and the amount of commission that will be used in that case will be 9,091. So you have to be careful that what is the basis of calculation of the commission. Now let us say we go to illustration 5, and in illustration 5 we have been given a trial balance. This is called trial balance of C12 on December 31st, 2017. And we are seeing a number of entries here of the trial balance. And we have been told that a value of the closing inventory was 2,70,000 rupees. So this is a valuation that is done physically. And finally, we have to make the closing entries or the closing adjustment entries also, and prepare the final trading and profit and loss account. So first thing that we have to do is we have to transfer the accounts. Now we have the trial balance here. The trial balance has to be, every entry has to be removed from the trial balance, and it has to go into the final accounts, which is the profit and loss account, the trading account, and the balance sheet. But while transferring the balances of respective accounts given in the trial balance, we have to do it by making appropriate journal entries. So first of all, we have to identify which are those accounts which will go into the trading account. We know that inventory account will go to trading account, purchases will again go to the trading account. So similarly, wages, etc. So therefore, to transfer these three accounts to the trading account, we have to credit these accounts because they are debit balances. So to square them off, we have to credit them. We will credit these three accounts and debit the trading account with the total. So thereby, when we are debiting the trading account with all these three accounts, the trading account will show these three accounts over there. Similarly, we have to transfer the sales account also to the trading account. There is a credit balance there, so we debit it, and by debiting we are squaring off the sales account and we are crediting the trading account. Our inventory in respect to our inventory also, we will be debiting the inventory account or inventory closing account and crediting the trading account. So thereby we are transferring the closing inventory that we have taken also through the trading account. This is the opening inventory or the closing inventory as on 31st December 2016. As we are seeing this, value of closing inventory on 31st December 2017 was 2,70,000. So we have to explain this that there is an inventory shown here 2 lakh rupees on 31st December 2017, and there is a closing inventory value that is shown on 31st December 2017. So we have credited the inventory that was shown here. As you can see, it is shown on the debit side. So there is a debit balance in the inventory account, and we have transferred it initially to the trading account, and then the closing inventory has also been transferred to the trading account by crediting the trading account. So that we arrive at certain profit and loss. We are arriving at a balance of the gross profit, and that gross profit is being now transferred to the profit and loss account by debiting the trading account with the gross profit, because there is a credit balance, which means the gross profit is 22,50,000 rupees. We square off the trading account and we create a opening entry in the profit and loss account by crediting the profit and loss account with the gross profit. Thereafter, we are transferring certain accounts to profit and loss account directly, because those accounts are related to the profit and loss account, like discount allowed account, salary account, and sundry office expenditure. All these are expenditure accounts which are not directly related to trading activity, and therefore they are transferred to the profit and loss account by debiting the profit and loss account and crediting these accounts. On the other hand, the discount which is received is also transferred to the profit and loss account credit side. So in that respect, profit and loss account will be credited and discount received account would be debited. After that, we arrive at a certain profit and loss account balance that we'll see just now. And so we transfer the profit and loss account balance, which is a net profit of 6,30,000 rupees, into the capital account by crediting the capital account with it. So this entry has to be explained here that this inventory which is shown here, 2 lakh rupees, that is the opening inventory, and as you are seeing, this entry is showing the debit balance. So this was the entry as on 31st December 2016. We have to understand that this is the entry of closing stock as on 31st December 2016. So basically, it is an opening stock entry, and the opening stock has to be taken to the debit side of the trading account. So we'll credit it over here and debit the trading account with it. And therefore, the trading account has been debited and inventory account has been credited, which means it is going to the debit side of the trading account. It is the opening inventory, not the closing inventory. And we've given the inventory at the bottom of the table here, 2,70,000. So in respect of this closing inventory, we'll be debiting that inventory account and crediting the trading account. Now, by introducing this entry, what we are doing is that we are opening a closing inventory account and we are debiting that account with 2,70,000 rupees. And we are crediting the trading account with 2,70,000 rupees. So this credit is going as a closing stock entry in trading account, and the same thing, the debit balance of the inventory closing account will go into the balance sheet straight away. So therefore, this entry is important here to be understood. So finally, we can see here that the closing inventory is shown here 2,70,000 rupees, and opening inventory is shown as 2 lakh rupees. And then once we have transferred the sales, purchases, and the wages, we subtract the total of the credit side from the debit side, and we get the balance of 22,50,000 rupees, which is the gross profit. And then this gross profit has to be transferred So we make the journal entry as we have shown above, that we credit the we credit the profit and loss account with this uh, gross profit entry and debit the trading account with it. So here it is debited and here it is credited. Thereby the trading account is now squared off and we have equal amount on both sides. And the profit and loss account, we have now got 22,50,000 rupees credit. Thereafter, some other entries like salary, other expenditures and receipts are debited as and credited suitably to the profit and loss account, and we get a final balance of that profit of 6,30,000 rupees here, and this will be transferred to the capital account by debiting the profit and loss account and crediting the capital account with it. Now let us go look at balance sheet. So far we have learned how to prepare the profit and loss account and how to prepare the trading account, and in between we have understood which are those entities which are going into the balance sheet also. Now let us understand what a balance sheet is and how it is prepared. A balance sheet can be defined as a statement. We don't say that it is not an account. A balance sheet is a statement which has got or which sets out the assets on one side and the liabilities on the other side on a certain date. Now, every single transaction that we are doing will certainly make some difference to some of the assets or liabilities. So therefore, as we go on making transactions, we are changing the amounts in the balance sheet also. We can take that in that way. Every transaction is making some change in the balance sheet. And therefore, the balance sheet is constantly changing. Balance sheet is not a stationary statement, it is constantly evolving and changing. So therefore, this balance sheet would be considered to be true for only a particular point of time, not even a date. The balance sheet is for a particular point of time, because even after that time, as soon as we make some transaction, the balance sheet will change. So therefore, when we use the word as at, balance sheet as at, which means as when we say balance sheet as on, then we are talking about a day. But when we say balance sheet as at, we are talking about a point of time. And therefore, the words as at are important and are more appropriate rather than as on. Now, assets are shown on the right side of the balance sheet and liabilities are shown on the left side of the balance sheet. Normally, we don't call them the credit and the debit sides, particularly for the reason that those amounts which are on the right side are having the debit balances, and those which are on the left side, they are having the credit balances, and therefore the system gets overturned here in the case of a balance sheet, because by convention the debit balances are not shown on the left side here, they are shown on the right side, and the credit balances are shown on the left side. Now, what are the characteristics of the balance sheet? First of all, the balance sheet is prepared on a particular date rather we prepare it on the close of the day. There is that point of time when the day is closing, and it is not prepared for a period. It is prepared for a point of time. It is not prepared for a duration of or a period of time. Rather, it is prepared for a point of time. Now, therefore, this balance sheet would be true only for that particular point of time. Now let us say that in the example which is given above, a part of the goods were sold on 1st January. Now this will mean that the value of the inventory will be reduced. The cash will increase because we have sold the inventory and we have got cash. And the capital account would be reduced or increased depending upon whether it has resulted into a profit or a sale. So therefore, as we can see, every transaction leads to a number of changes in the balance sheet. So balance sheet is prepared after preparing the profit and loss account and not before that. And therefore, the profit and loss account, including the trading account and the balance sheet, are together called final accounts. Although balance sheet is not an account, and the two sides of the balance sheet are not the debit and the credit sides. But however, if the balance sheet is not accompanied by the profit and loss account, we will not be able to light or throw adequate light on the financial position of the firm. And therefore, when we say final accounts, what we mean to say is profit and loss account, trading account, as well as the balance sheet. Whenever we use the word final accounts, it means all the three: the profit and loss account, trading account, as well as the balance sheet. Although balance sheet by itself is not an account. So for that purpose, if we have to understand the financial position of any firm through the balance sheet, it is also necessary to understand what is to appreciate what is the profit that is being earned by the firm. Now, since capital always equals the difference between the assets and the liabilities, asset minus liabilities capital, that is the equation. And since the capital account will independently arrive at this figure, because capital account is being debited and credited every now and then, and ultimately we find that asset minus liability becomes equal to the capital account, is always equal to capital. So therefore, if we put the capital on the left side of the balance sheet, then both sides of the balance sheet should have the same total, because capital plus liabilities would be equal to the assets. Now, in the above illustration that we just saw in the illustration number 5, we can see that there are these 6 accounts which have not been closed even after the preparation of the profit and loss account, and these accounts are still remaining to be closed because ultimately these accounts are still having the balance in them. For example, the cash in hand account is not taken out of the trial balance, capital account is not taken out of the trial balance. All these accounts are still lying there in the trial balance. And in the closing inventory account also, we are having a debit balance of 2,70,000 rupees. Now, when we look at these accounts, we would know that these are all asset accounts, like cash balance in hand, cash at bank, machinery, furniture. These are all the assets which the firm possesses. And we have not transferred these accounts balances anywhere so far. Of course, the accounts which are having the credit balances, they are the liabilities of the company, like trade payables is a liability of the company. Similarly, capital account is also a liability of the company because this amount is supposed to be paid to the proprietor ultimately. So therefore, we need to present all the assets, all the liabilities and the capital in a statement which is called the balance sheet. So let us prepare the balance sheet on the basis of the trial balance that we have seen in illustration 5 above. So all these 5 accounts which are remaining to be entered anywhere because all the other accounts have been already squared off. So these 5 accounts which are not yet squared off, these will find a direct entry into the balance sheet, as you can see here. And when we enter them in the balance sheet, and but we include the balance in the capital account also, we find that the both sides of the balance sheet are tallying exactly. Now, we come next to how the assets and liabilities are arranged in the balance sheet. So assets in the balance sheet may be grouped in 2 ways. The first method is to group them by liquidity. And under this liquidity approach, the asset which can be converted into cash initially is presented first. Whatever can be converted to cash fastest is presented first. And those assets which are most difficult to convert into cash are presented at the bottom of the balance sheet, of the asset side of the balance sheet. So if we look at the liquidity approach, the balance sheet should look like this. And in the liquidity approach, the cash which is easily liquefiable, or the asset which is equally liquefiable, which is easily liquefiable, whatever asset is the most easy to liquefy means convert into cash, is mentioned at the top, and those who are more and more difficult to liquefy or liquidate, those assets are put down below. So as you can see, land and building is the most difficult to liquidate out of these. So they are put in the sequence of liquefiability. And second method by which sequence of the items on the asset side is the permanence of those assets. So this is like, the more easy to liquefy, the more less permanent, and the more permanent and less easy to liquefy. So as you can see, on the basis of permanence, this whole balance sheet amount is turned around totally. So we can say permanence is opposite to liquidity. And when we go by permanence, we are completely overturning the entries, the sequence of the entries. So we should note that some of the assets may be capable of being sold easily, like investment in government securities or shares of some companies. So they should be treated as liquid or permanent according to the intention of the firm, whether the intention is to sell them off or the intention is to keep them for more time. Accordingly, they can be put in the sequence as desired. Similarly, just like assets, even the liabilities can be suitably entered in a particular sequence. So liabilities can be shown according to the urgency with which the payment has to be made. One way is to first show the capital, then we have to show the long-term liability, or the liability which has to be paid latest, as late as later on, and last of all, we'll have the short-term liabilities there, which means the liabilities which have to be paid off sooner. Like most amounts which are due from the supplier of the goods or from as for the bills payable, will be entered at the bottom. So capital followed by long-term liability and followed by the short-term liability. That will be the sequence in the first method. In the second method, the other way, we start with short-term liability and then move towards the long-term liability. So this is the opposite of the first method. Now, assets are normally divided into two types: the current assets and the long-term assets. And among the current assets, we include those assets which can be converted into cash as quickly as possible, and generally within 1 year. So all those assets which can be converted into cash within 1 year, they are like cash in hand, cash in bank, trade receivables, inventory, etc. So these are the current assets. They will be used by the firm for over a long period and will not be sold. So among the long-term assets, the most longest period assets will be the fixed assets. For example, machinery building long-term investment. And third type of assets are the intangible assets, which have no physical existence at all and cannot be seen or touched or felt by any senses. They are called intangible assets. For example, patent, copyright, etc. are intangible assets. So there are three types of three broad categories of the assets. So it is in the balance sheet, the two types of assets should be shown separately. Like we should show the current assets separately and the long-term assets separately and prominently. And in fact, the third type of assets also, like intangible assets, should also be shown separately, and this will look more meaningful and logical. And similarly, even in respect of the liabilities also, those liabilities which are to be settled within a year or so or lesser should be included among the current liabilities, and the others which will take more time, likely to take more time to settle, that would be included in the long-term liability. So these are the broad categorizations that are being made inside the sheet. And initially we saw the sequence in the balance sheet, and now we are seeing that categorization of the assets and the liabilities. As you can see here, the tangible fixed assets have been first mentioned, then the intangible assets are being mentioned, and then of course the investments are being mentioned, or long-term investments are being mentioned, and thereafter we have the current assets. Third type of the asset, which are the current assets. So basically we are having the tangible fixed assets, the intangible fixed assets, and then we are having the long-term investments or investments, and then the current assets. That is a categorization of the assets. And among liability, we start with the capital, and in the capital we add net profit, we reduce the drawing from it, and then of course long-term loans. The loans are of two different types: term loans and other loans. Then short-term loans are included: cash credit, overdrafts, other loans. So we are moving from the long-term liabilities towards short-term liabilities, and finally we move to current liabilities, which are the trade payables. And after that, we go to the provisions. So provisions are entered last of all in this sequence. So we have seen the sequence and the categorization both. Of course, for the presentation of assets, liabilities, and equities, There is no hard and fast rule. It's not mandatorily prescribed, except in the Companies Act. For companies, it has been prescribed. However, for others, it is a model presentation which has been designed considering the nature of the elements of the balance sheet, and in order to categorize them appropriately, it is being done here. However, if we present properly the balance sheet items, then it will improve the understandability of the information that is being entered into the balance sheet, and therefore it will help the users to use that information or understand that information which is communicated to them very easily. So that is how the sequence in the balance sheet is recommended and the categorization in the balance sheet is recommended. We come to the end of today's session, morning session, and we continue with the same topic in the next session in the evening.